everybody knows if you make $20, you give $5 back to the government, give or take. But what you're telling me is that if I make $20, I can put some of that $5 in certain other accounts with various strategies, and maybe I don't have to pay as much back to the government. Is that tax planning, Clay?
I would say that classifies as tax planning.
Boom!
Yes.
Episode done.
It's a little bit more complex than that, Dan.
Fair.
Welcome to It's All Money. Your hosts are right here in front of you. We're checking out It's All Money.
Welcome inside the Sonoma Wealth Advisors Conference Room. We're right off the Sonoma Square in Sonoma, California. How many times did I say Sonoma? My name is Dan Elweir. I'm the marketing director and podcast host here of It's All Money. I'm joined today once again by Darren Blonsky, CFP, as usual. And for the first time on the podcast, our advisor who has particular interest in, he gets excited about taxes, Clay Dunkle CFP. Welcome, Clay.
Thank you, Dan. Glad to be on the show.
Funny story about that, right? So it's Saturday morning. I think I'd just gotten back from a baseball game or a basketball game or a soccer game for one of my kids. And I get this note from Chris. And Chris says to me, Darren, Clay and I did this tax analysis and we calculated the lifelong tax expectation of this client. And if we do these Roth conversions on these and these years, we're going to save the client like $1 million. And he was legitimately stoked about it.
On a Saturday morning.
Saturday morning.
Like, oh.
And I'm like, Chris, man, I love that you're my partner because I love that you got excited about that.
Yeah.
And that's Clay.
That's what it's all about.
Yeah.
That's right. Okay, well, I always start with a really simplistic explanation to try to make things clear. What is tax planning, Clay? Because most people just think of taxes and they think of, okay, I needed to do my taxes. Tax planning, tax service, what are they and what is the differences?
Tax planning. So I can't give you a super specific definition. It's going to be broad, so you might not like it, but
It's for educational purposes only.
I would say tax planning is, analyzing a client's situation and making sure that all of the different pieces involved are working together so that they're paying the least in taxes. And that could be short term or that could be medium or long term.
They're paying their fair share of taxes.
Fair share, sure.
Correct. We don't want to say least, but it's the fair share of taxes that they appropriately owe.
And I think that's such a key point is because whenever you get into the realm, and I'm still new in the industry, which I think is a real benefit for me because I bring in what I think a lot of people presume about financial services. So when someone starts goofing with their taxes or they start doing things to help improve their tax situation, the impression is there's a bunch of write-offs and you're going to get to zero. Ha ha ha, I did it. What you're both saying is that no, everybody pays taxes, but there's a way to pay your appropriate amount of taxes and there's a way to pay way too much in taxes.
Correct. I always say there's tax law for the informed and there's tax law for the uninformed. And there is, let's be real. If you looked at the tax code in the United States, it would probably stack higher than this, paper to paper to paper, right? There's over 300 changes per year in the tax code. We're going to get a lot this year in 2025. And the nuance of that is complex. And whenever they create a law, it has unintended consequences. So the way I like to imagine, I remember growing up, there was this empty lot across the street from my house, and there was this old house and an old chicken coop that became a barn, which is very common in Petaluma. And then they started building all these different buildings against this old chicken coop. And eventually that chicken coop from internally fell over and everything else fell over. And I think about the tax code that way. Like it's all these like chicken coops and buildings built here and over here and it's over here. And it's overwhelming. So our job in tax planning is to help you navigate with our CPAs and our EAs on staff and our CFPs on staff to pay your fair share of taxes, what you lawfully owe, but not to overpay in areas that you don't lawfully owe.
Okay, so tax service is what everyone has to do every year, which is you have to file your taxes. So that is a tax service. You would typically do that with a CPA.
Or EA or tax filer now, or
EA,
CTEC.
enrolled agent. That is, you show up with your W-2 and you fill out all your information and you get them their documents and they process it, or perhaps use a software program for it and you do it yourself. That's tax service. At that time when you're doing tax service, there are deductions that you can make, which are going to affect your tax bill one way or another. But what you're talking about is tax planning, which would happen ahead of time. And can you give an example of some of the strategies you use? For someone who's trying to conceptualize this, what strategies are used for tax planning? What are some of your typical moves you might make for someone? It's everything is specific, but
Yeah, that's a tough question, nailing down something specific. I think we can talk about the different areas that are affecting tax planning and maybe go from there.
Yeah.
So let's put it in an example, right? Let's say we bring on a new client. We're going to collect a few years of tax returns so that we can see what's going on under the hood up to this point, right? Last few years, here's their income, here's their deductions, here's what they own. Here's some debt, right? Getting that picture of what's going on. Then we're going to ask some questions and really understand in their mind, how they have their assets and liabilities and their whole financial picture structured. How is that supporting them to get to their goals? And what are their goals going forward? So we're talking about, personal goals and personal information in general. Do you have a family? Do you have kids? Are you married? Are you all in good health? Parents, are they in good health?
Do you want to move somewhere in the next 5 years?
Yeah, do you want to get out of
buy
town?
a boat? Do you want to start a small business? Do you want to retire? Do you want
Tons
to
of stuff.
All of these are things that people will share and that greatly affect what the financial plan might be.
Absolutely. So that's on the personal side. Then there's the business side. Do you own a business? How's it structured? Is it an LLC? Is it an S corp? What state is it? Are you incorporated in? Do you have an exit plan? Do you know what an exit plan is? Do you have employees? Then you can go to other investments. Do you own real estate? Do you have investment property? Do you own your own house, right? Or are you a renter? Then there's retirement. Are you doing a traditional retirement plan, utilizing accounts like a 401k?
Well, I'm a
IRA,
realtor.
Roth?
I can't have a retirement plan.
Or are you going that route where you just buy a bunch of real estate and you're relying on the cash flow to fund your retirement?
But a realtor could have a solo K, could they not? Right?
Yeah,
it's something
they
may
Sure.
not know, right?
Yeah, but just getting that picture, right? What are you doing today, and how can we optimize that going forward? And then other investments, right? It's not all just retirement assets. It's you might have a brokerage account or a trust account with some assets that you've been putting away. Understanding what those are earmarked for in the client's eyes. Is it a source of potential, down payment on a property? What's the cost basis? What did you pay for the assets and what are they worth? Is there any flexibility there? How are they being managed? Are they being managed in a tax efficient way for the client situation? So I think all in all, right, there's hopefully that gave you kind of a taste of how complex it is as a whole.
Mm-hmm.
And for us, we're trying to bring all those pieces together, put the scenarios together and say, okay, here's the base case. Here's where you're at today. And here's, what your tax plan has looked like up to this point. Here's what we think you could do better to save some money and help you achieve your financial goals as well.
Save some money in the taxes that you're paying.
Right. Yeah.
Darren, it's kind of counterintuitive that a financial advisor would be the person who's doing my tax planning, because people are so hard-coded to think tax CPA. But in fact, tax planning can kind of be a wealth building strategy as well, can it not?
Absolutely. So there's an old saying that says it's not what you make that matters, it's what you keep that counts.
I knew that was coming.
Yeah. One of my favorite sayings with people, right? Like, it doesn't really matter if you made a bunch of money if you're going to pay most of it to the government. Like that's just paper
I made
money.
$1 million this year. I paid $500,000 in
Right.
taxes though, so I only made $5. This is what I do on these NFL stories all the time. They're like, so and so got a $320 million contract. I'm like, well, it's actually not that much.
That's right.
Cut that in half.
And so we have to think about those options, and when we look at how people structure the way they receive the income they receive, whether it's from a windfall, whether it's from the income from working, whether it's from an inheritance, there's ways to navigate how you receive that income and then how you invest that money to benefit you and keep more in your pocket. And that's the essence of tax planning. What we've seen is that it's incredibly difficult to pass the CPA exam, and doing tax prep work is a very difficult job because of the impact it has on the lifestyle of the individual who does taxes for a living. And because of that, we're seeing a massive shortage in the number of people in the workforce actually going in to become a CPA or EA. Very, very difficult to find those people that want to do that. And it's because it's a lifestyle thing. It's not a very good lifestyle. I mean, you think about it, from January to April 15th, the 60, 70, 80-hour weeks. And then they get some time off after.
But you got the October extension deadline
Right,
too, right?
exactly.
So you got a second little mini
Round of it.
stress period.
We actually found through COVID, more people are on extension now than used to be, right? So now the tax season's getting stretched, so it's making it even worse.
Right.
So it's a very difficult lifestyle thing. So a lot of people going into it, and the tax code doesn't seem to be at this point getting simpler, more complex.
Yeah.
So you need that person to discern that for you and help you through that process. And what ends up happening is CPAs, EAs, they get overworked. There's just too many clients. They don't have the time to sit there and say, well, Dan, had you done this differently in December, you would have paid less in taxes. They're more reactive now. Taxes go in. It is what it is. Here's my 1099s, etc. And the person just has to deal with it.
Right.
So what we do in tax planning, to the degree our licensing allows us to guide the client in a way that says, well, if you do this, it's more efficient than if you do that. Or if you convert a bunch of pre-retirement IRA money now to a Roth, you'll pay less taxes over the long term. Those would be two instances where we would help an individual sort through that. A tax professional, in theory, might have the time to do that, but it's very difficult nowadays and costly. The prices on paying a tax person are going up because there's so much demand and very little supply.
And you're, again, speaking to the idea of appropriate tax. The IRS is never going to tell you once you send your taxes in, over the lifetime of your investment, you could have actually used these types of accounts and saved yourself some taxes. We just wanted to let you know.
Most definitely not.
They're never going to tell you that. So you can do it the expensive way with the IRS, or you can do it the appropriate way with the IRS. As long as it's within legality, they're going to let it pass with your taxes. They're going to, hopefully not going to get audited, but I mean, as long as it's within the bounds of the law, they don't particularly care necessarily, but they're never going to come back and tell you, gosh,
you could have been more efficient.
Just so you know. So it seems like this tax planning is the work that you do on the front end ahead of time, a year, even years ahead of time, that ultimately when the moment comes, you're going to pass through the door with lower tax bill than if you had just not worried about it at all. Is that true?
Yeah, that's fair.
It's actually interesting too, because as an advisor, we're always very focused on creating value for our clients, right? And so if we do our tax planning right, we'll save that client a lot of money over time. They won't necessarily know it because it's what they've come to know. Had they just not planned and paid the taxes as they thought they should have, then they'll have a very different experience, and that's what they'll have come to know. And so it's interesting when we're always trying to memorialize value for the client and saying, well, because we utilize strategy A instead of strategy B, this is the benefit to you over a long-term relationship with us.
Which is different than their expectation with a financial advisor, which is I have a graph and I go, look up and to the right.
Yeah, that's right.
in the green area.
That's right.
Percentage number, huh?
That's right.
That's a win, right?
Yeah.
It's harder to say, okay, well, actually, we didn't pay as much. This went down. The tax bill went down, and that's a good thing. Down and to the right is also good.
Yeah.
Well, counterintuitive.
Yeah. You don't get to put the tax saving on the performance report.
Correct.
Yeah.
Correct. We've got a couple of slides. This is an educational only scenario. I wanted to put a couple of numbers to this just so you could wrap your brain around this if you're trying to conceptualize what tax planning is. So today we're going to meet John Doe, because John is not tax planning yet. He hasn't been till this point. And for the first time, John's saying, I'm going to do some tax planning with whoever, not even necessarily with Sonoma Wealth Advisors. So John makes $579,000. His deductions are $44,000. His taxable income is $534,000. His marginal tax rate, which is what people would consider typically what you would call your tax bracket, is 35% at that large number. His average tax rate, Clay, will you want to explain marginal versus average tax real quick?
Average tax rate is going to be the total tax bill for the year divided by the total income. So by definition, right, that's an average. Marginal tax rate is the bracket that you fall in where your next dollar of income will be taxed. So that's the difference.
So the percentages of the dollars that you make, say 0 to 10,000, I don't know the brackets off the top of my head, is going to be a different percentage than, say...
It's okay because they're going to change.
The first $10,000 that you make is going to be a different tax percentage than the $100,000 to $200,000 that you make.
Right.
And so when they calculate with the average tax. So right now, John Doe is paying a total tax of $137,000. So when you do tax planning, tax returns are analyzed. Some more notes about John Doe. John takes Social Security. John's on Medicare. John donated $20,000 to charity. He claimed $14,000 on his mortgage interest, and John has an annuity.
Sold by a broker.
So let's take a look at our notes. Some observations that you might find in this generic educational situation that we've described is that John's income is too high to contribute to a Roth IRA, so he might consider the feasibility of a backdoor Roth strategy. Clay, what is a backdoor Roth strategy?
Well, the IRS does not allow you to fund a Roth directly if you exceed a certain level of income. So one of the quote unquote loopholes in the tax code is that
it's not a loophole. It's a planned usage of the tax code.
Yes. What you're allowed to do is make a non-deductible contribution to an IRA, which is a pre-tax, right? There's the pre-tax and there's the Roth. So you can make a non-deductible contribution. The reason it's non-deductible is because the same limits apply to the Roth contributions, right? So you're over that income limit. You make the contribution to the IRA, it's non-deductible. You turn around and do a conversion into the Roth, effectively doing the same thing as making a Roth contribution. I have a question. Is John, I thought I saw that he was a handyman. Was that on the last slide, or did you?
Yeah, John has a small handyman business.
Gotcha. So that's a strategy, right? Looking at the back door, but also, because he's self-employed, he might consider one of the retirement plans that's available for self-employed individuals, like a solo 401k.
So backdoor Roth is they put it non-deductible donation to an IRA, and they're able to immediately then, once they've created that account, roll it to a Roth.
Right.
Charitable contributions over $10,000. If more is planned in the future, consider a donor advised fund. Darren, what is a DAF, or a donor advised fund?
So in 2018, in the Tax Job Act, they raised the standard deduction, we call it, for an individual, which made giving to charities on the federal side less meaningful from a deduction standpoint because you had to achieve a certain threshold. So one of the strategies that you can deploy is you gift. So say I'm going to give to charity over the next 5 years, $10,000 a year, so $50,000. Should you have the cash set aside, you can give $50,000 into a DAF, a donor advised fund, take the deduction in the year that the $50,000 was given to the DAF, the donor advised fund, but then dole out the gifts to the charity of choice over a period of time, thus raising that deduction because you go past that standard deduction. So it's a way to qualify some charitable intent for deduction that otherwise would not be because it was under that standard deduction threshold.
So if it's under the standard deduction, so if I was going to give $10,000 a year for 5 years, every time I did that, I would be under the standard deduction.
And you wouldn't get federal
and
credit.
I would get
you get
no,
state,
I would
but not
get
federal.
no federal credit. But if I did it 50 all at one time, then I would get the credit that year.
Because you exceeded the standard.
And then the DAF is able to distribute the money to that same charity. So nothing changes for the charity. The only thing that changes is you're able to get the tax credit for it.
Yeah, and you can control the DAF, right? You can say, I want to give X amount when you want to give it to that charity. You can even change the charity and say, I want to give it to a different charity now or whatever.
And you can invest the money.
You can invest the money and let it grow.
Yeah.
That's right.
So John's loving these insights so far. Let's get to the next one. A portion of your annuity distributions.
First question I have is, why does John even own an annuity at this age? But that's not here or there.
This suggests some after-tax basis in the account, a rollover, a tax-free Roth distribution, or a qualified charitable distribution. What can you say to that particular assertion, Clay?
When it says a portion of your annuity distributions was not taxable, so you have to go into, here's the tax code again. We have something called first in, first out, and last in, first out. And so annuities have a taxation of such that if you put your money in it, that's called basis, just like you would invest in a real estate property, okay? And you invest that money and it grows in the annuity. If that money grows from what you invested in, the portion that it grew by and it comes out of the annuity is taxable. First in, that's the first in, first out. The last in, first out is the annuity rule, right? So it's coming out of the annuity and you're paying taxes on that income. But this says a portion of your annuity distributions was not taxable. That's because some of your basis came out of the annuity.
That would tell us that it's annuitized, right? They're
That's
getting
right.
payments, and then they calculate it as a ratio of what you put in versus what the earnings are, and each distribution that you receive is going to be taxed according to that
That's right.
ratio.
That's
Correct?
right. Yeah. So there's a portion that's not being taxed, a portion that is being taxed, right? So you can utilize different strategies when that money comes out, and which will impact, we talked about earlier, the marginal tax rate,
Right.
and how we distribute at where on that marginal tax rate, right? So planning how income comes out of annuities is pretty important. So unfortunately, a lot of people have been sold a lot of garbage annuities over time. I know.
Hot take.
And
Hot take, bro.
so part of the job we do is we can't make bad, there's not much you can do. And bad is bad, but we can make it a little bit better for you. And so planning how we distribute income out of those annuities in the most strategic way that's beneficial to you to not pay a higher tax rate on it is part of the tax planning process.
Speaking of real estate, you mentioned real estate earlier. This is something to consider if you own a home. It's kind of annoying, but this last suggestion analysis I think is important. Keep track of your home improvement expenses for cost basis adjustments in the event of home sale. This is a pain in the butt because you got to keep all the receipts, but it can help you to come time of sale. If you've made capital improvements to that house, it can reduce your tax bill, which is not something that everyone knows and not something everyone's necessarily keeping active track of.
So to think about it this way, Clay, so if I buy a house for $500,000 and I sell it for $1 million and I have $500,000 profit on that house, it's not a trick question. What's the
Are you
taxes?
married?
Am I married? Exactly. Why? Why are you asking that?
Well, that affects the calculation, right? Because
So if I'm not married, how much is taxable?
if you're not married, you have a $500,000 gain no matter what, right? That's your gain. Now, what can be excluded depends on whether you're married or not. If you're single, you can exclude $250,000 of that gain. If you're married, each of you gets the $250,000 exclusion for a total of $500,000. So in your scenario, if you're married, you bought the place for $500,000, sold it for $1 million. No, not really a taxable event there.
But if I sold it for $1.2 million and there's $200,000 in gain that I can't use the exemption for, And I've got $50,000 in receipts that I've raised my $500,000 basis to $550,000.
I put in a new HVAC. I did fence work around the property. I did
Maybe not everything qualifies.
Yeah,
so you
not
need to
everything.
check, and that's where the CPA
Right.
is going to come in and make sure it's right. But
Right.
like, you know, some paint does, but not all paint,
Right.
per se, right?
It's like maintenance versus actual property
correct.
improvements.
But
right.
some what would be considered capital improvements. So I didn't just let this house sit there and gain and appreciate. I put in money into this house,
yeah,
and I saved the receipt. That
That's
can
right.
reduce
your tax.
Yeah.
Exactly.
And nobody thinks about it until they're considering selling. And the CPA says, well, do you have your receipts?
I can't tell you how many times I've had clients come in, they'll be like, hey, I want to sell my house. What's my taxes going to be? I'm like, well, I can't answer what your taxes are going to be, but let me ask you this question. What's your basis in the property? And the client goes, what's that?
Yes.
And I say,
Huh?
out. This is going to be painful.
Yeah.
So that's tax planning. If you have an advisor currently, if you're working with no one, perhaps you might ask, hey, I'm not getting that. Hey, I'm not getting that. I've never done tax conversation like that before. I've never known that you should be planning a year ahead of time for taxes. We do that at Sonoma Wealth, and you can learn more about us at sonomawealth.com. You can work with Clay, Darren, and our staff and get some of these same observations on your situation. Clay, thanks so much for joining us today. Appreciate it. First time on the pod.
Yeah. Thanks for having me. It was a blast.
You survived. If you're new to the channel, your first time watching, make sure to subscribe, and sonomawealth.com for more on Sonoma Wealth Advisors.
This content was produced by Fermata Advisors, LLC, an SEC-registered investment advisor. DBA, Sonoma Wealth Advisors. The opinions expressed by Fermata Advisors, LLC on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Viewers and listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance.